Hey guys, so I thought I'd just do a quick video today and explain my thoughts on what's happening right now. We're going to cover a few things. Firstly, the new variant that's come up in Southern Africa, a few updates to Chinese markets and CCP regulatory authority. JPOW came out with a couple comments, and then finally, what's actually happened in the markets on Friday and what might happen over the next week. Obviously, this is not a normal format for my video. I'm actually on holiday right now. Pretty poor timing for me, but I thought I'd just try and get something out for you guys in the meantime. I was hoping to get a video out on the beach, but there's about 80-mile-an-hour winds because we're stuck in the middle of a storm here in the UK, so that isn't too feasible either, so this is where we are for the day. Right, so to kick us off, this new variant that was originally going to be called the new variant and has now been called the Omicron variant, which is a little bit funny because, well, obviously after new in the Greek alphabet comes G, and apparently they can't have a COVID variant called G because it would be a little bit too ironic considering where the virus started and the state of the Chinese Communist Party these days. So we call it Omicron. Okay. As of yet, we don't actually know a lot about the virus. I've looked at what a lot of virologists have to say online, and the consensus is basically no one knows yet. It's going to take at least a few weeks until we find out if this variant really is more contagious, if it really is more dangerous, and what the reactions are going to be in response to that. Right now, it does seem like maybe it's more contagious. It does seem to be picking up in these South African countries, South Africa, Namibia, Botswana, Lesotho, places like that. And as a result of that, a lot of countries have locked off travel from them. The entirety of the EU, the UK, the USA, and a bunch of other countries have basically instituted a brand new travel ban on these SADC countries. Now we'll see if this is actually effective or anything, but there are already recorded cases in countries like Belgium. So if it's in Belgium, it's probably in the entirety of the Schengen area. It's probably in the US and Asia as well. So to be perfectly honest, I'm very skeptical as to whether or not any of these travel restrictions will actually do anything good. At the same time as this is happening, there is another COVID spike in a fair few countries around the world, and most notably in Europe. Austria, Germany, the Netherlands, Denmark, a lot of countries like this are seeing an awful lot of cases and actually deaths rising as well. And so their governments have sought to lock down again, albeit not as strict lockdowns as they have been in the past, but curfews and restrictions on certain businesses and things like that. So that's certainly not good for the continent. And if this new variant does start to spread as well and it is worse, then that's going to be even worse for Europe in particular. There are a few new pieces of news from China as well. Didi, the company that has been basically harassed by the CCP at this point, is going to be forced to be delisted from the US exchanges. This isn't a huge surprise to anyone who's paid attention. When they IPO'd, within a couple days of them going public, the Chinese Communist Party and their regulatory authorities came out and said that Didi's been naughty with their data, which, to be honest, there isn't any evidence to suggest that it has, but that they need to be punished and fined and that they'll no longer be able to grow their user base in China as a result of that. This news seems to just be an extension of that policy, punishing this company for daring to IPO, to list, to try and do some kind of business in a country outside of China and not put their sovereign nation first. To be perfectly honest, if you've bought Didi shares, then I don't know what to say. Jim Cramer got to you. You were silly. You shouldn't be buying companies like that, which are under threat from the CCP in the first place. But maybe you thought its downside was so low and its upside so huge, but I guess that's just not the case this time. There are chances that more companies like Didi are going to be impacted. A big one is XPeng, a big EV maker in China, one of the top 3 EV car companies in the country. It's listed in the US, and I wouldn't be surprised at all if it is a future target. And on top of that, there are 100 other companies in similar positions who have made the mistake of prioritizing business and market efficiency and capital raises as opposed to keeping the CCP happy. And a lot of them are probably going to suffer at the hands of the CCP as a result of that as well. If you own these companies, if you own stocks in Chinese companies that are listed in foreign countries, you need to be aware of these risks and you need to look into the likelihood that this happens to you and what might happen to your share price. If you own Didi, you're going to have to trade shares over the counter. The share price isn't going to collapse. It's not going to be worth zero tomorrow, but it will take a big hit as it is delisted. That's just the simple truth, I'm afraid. China's also seeing some bad signs for its economy as a whole. Obviously, the housing market has already been falling 1% a month at the moment, and we'll get more data on that soon. Meituan, a company like Uber Eats or DoorDash, a food delivery service in China that's absolutely huge, it's posted its biggest ever quarterly loss, and this was a bit of a surprise to investors, which caused the share price to drop a bit. And in my mind, it's indicative of a weaker Chinese economy in general. Tencent, another huge company, far more popular, but worldwide, world-renowned, really incredible stuff. Well, they've just posted their slowest quarterly growth since 2004, which is really bad news for them. The property industry is struggling still. Kaiser Group, a company that's already started to default on its bonds and its debt obligations, has just sold its last fully owned development, and it still has loads of debt to pay, so that isn't looking too bright either. Assets at Evergrande are being liquidated by the owners and the executives to try and pay off these debts, but the problem is these people, these executives, they may be wealthy, they may be billionaires, but they don't have nearly enough money to pay off all of the debts and all of the obligations of these companies. They're merely buying them time, 6 months, 9 months, 12 months at the most. They can't do any more than that. So yeah, the news from China isn't brilliant either. Jay Powell is obviously keeping his job as Federal Reserve Chairman, which is good or bad. I'm not too sure at the moment. We'll see how he responds and how he acts over the next year or 4 years even. But it wasn't too much of a surprise that he was given that position again anyway. He did come out and say a few things. He said that we can expect maybe 3 rate rises over 2022, which basically means we're going to see, in his plan at least, interest rates rising to about 0.75% over the next year, which is really a very small figure anyway, and it's just a notional attempt to fight inflation. It wouldn't actually make any real dent and slow down the economy much at all. And so that brings us on to what actually happened on Friday. Well, the markets took a bit of a hit. Pretty much across the world, actually, and almost every asset class started losing value. The S&P was down over 2%, while the Russell 2000 was down over 3%. The Nikkei was down over 2.5%, and Europe as a whole was down over 3%. Some specific countries got hit harder than others. France's index got hit by almost 5% on one day, which is a pretty huge hit for them, especially since they haven't had this huge run-up that the United States has had over the last year. And something that no doubt a lot of you will be wanting to talk about, crypto had a big rout as well, falling between 10 and 20% across the board. Almost every coin, every currency is down, and we'll get into the reasons for that in a moment. Surprisingly enough though, gold was up 1%, which sort of pushes the idea that gold is an effective market hedge, at least more effective than Bitcoin or other cryptocurrencies at the moment. There is a big belief that Bitcoin is digital gold and that it's a hedge against inflation and tough market conditions in general. And I think that there's a very good chance that it could get to that point in the future, but I don't think it's there. And I think this last week has sort of given evidence towards that end. When the stocks crashed, crypto crashed as well, including Bitcoin, whereas gold, a market hedge, went the opposite direction, it rose. Crypto is still a very volatile asset. It's still a risk on asset. It is market correlated, unfortunately, and while it could get to the point where it isn't in the future, it isn't there yet. And so people investing in Bitcoin because they're preparing for a crash need to be careful about that. They need to look at the evidence of what the markets are actually doing, not just what they expect them to do. In general though, this is short-term price action. It's not terribly important in the long term. We should be looking at months and years and trends that we see in the markets, not just snap crashes that we see when some bad news about a new COVID variant coming out. Let's say though that the variant is really strong, it is contagious and it is dangerous and it does cause more lockdowns. What are we going to see as a result of that? Well, right off the bat, it would probably reduce consumer demand, and in a world where consumer demand is really high and we're seeing 0.9% inflation a month, that could be a good thing. This could serve to reduce inflation, which would be lovely. A good example of this is oil prices crashed to the $70 a barrel mark, which will reduce costs for pretty much everything in the world to a certain degree. Lockdowns in this sense would probably be good for short-term inflation, but there is a big caveat here. Long-term, lockdowns would probably be awful for inflation because it would change government policy. Governments would be inclined to start more quantitative easing, more money printing. They'd send out more stimulus checks, they'd increase benefits, they would send out more furlough checks as well, and they'd just spend more money. You know, the $1 trillion infrastructure package would probably get inflated, and they'd spend more money to support the economy, and in the long run that will cause more inflation. We've seen it happen over the last year. It would just happen again, and unfortunately our politicians don't seem to have much foresight. They just focus on the now, on today's polling results, and they don't care about what their actions do in the future. There's also the fact that supply side shocks and shortages in things like the labour market and shipping delays aren't going to be made better by more lockdowns. They're going to be made even worse. So these supply side impacts that are impacting inflation as well, if there are lockdowns, those are only going to get worse. There's not really any world where they get better, even if demand is subsided a bit. In general though, I think we shouldn't be expecting an instant 30% crash here. What we saw in 2020 when COVID first came about was very, very unique. Usually market crashes coincide with recessions, and we didn't really see a real recession because of the response of our governments. We saw stocks drop over the course of a couple weeks and then rise over the course of a couple months. But that's a time frame that is really, really rare in the grand scheme of things. Usually when a recession happens, the markets fall for 1, 2 or even 3 years at a time, and then they take even longer to recover. A lot of people point to the fact that so many people have cash sitting on the sidelines that they would just buy any dip, and that's why there can't be a market crash. But psychology changes, and investors change, and their risk sentiment changes. And when you see the markets drop 10% and you buy in, and then they drop another 10% and you go, oh, okay, well, let's buy this dip, it's the bottom one. And then they drop another 10% every month for 2 or 3 years on end. People lose faith in the system and they stop investing as a whole, and they just decide that their risk tolerance is not strong enough to invest in this market, and so they get out in general. That's the sort of thing we should be looking out for. We should be considering consumer investment and risk sentiment and seeing how it develops, and if it does all drop in cohesion with each other, then we have a real problem on our hands. I know a lot of people are probably expecting me to say that this is it, this is the big crash, but I don't actually think the new variant is of concern. We've had loads of new variants over the last year, and when news first comes out, it's always inflated by the media organisations. They always say it's more contagious, it's more dangerous, it's more deadly, and it's going to cause another lockdown. And then when we actually get the data a few weeks or a couple months later, we find out that it's not quite as bad as we feared, and we mostly just continue to treat the virus as it was before. We saw this with the Delta variant, but we saw it with a bunch of other variants as well. In the UK, there was one called the Kent variant, which saw the exact same media cycle. And so I'm just a little bit skeptical of what I hear on BBC or from CNN and things, because they've done this before and they've been wrong before, so why should we believe everything they tell us now? Let's wait for the data to come out from virologists, give them time to analyse what they're seeing, and then we'll have an actual good idea about what might happen. Nonetheless, the virus in my mind isn't the threat that the economy is facing. It could be a trigger that causes the economy to collapse, but the threat is that our markets are ridiculously overvalued, and the money supply has been increased far too much in such a short time frame, and we're seeing inflation skyrocket. We're seeing consumer sentiment drop off a cliff to 10-year lows when no one really expected it. These are the real risks to the market, not a new variant. But that new variant could be a trigger which causes those risks to come to the forefront of investors' minds, and that could be the trigger for a big market crash, a rout, a recession, or whatever you like. In general, I think that some countries have just gotten past caring about the virus. In the US especially, people are mostly just getting on with their lives and accepting that it's sort of like the flu now. There's just a second flu and it's a bit more deadly and it's going to kill people every year. But people in Europe, on the other hand, are on the other end of the spectrum. They're still trying to fight the virus as much as possible. They're still willing to accept lockdowns, and I don't know how long that's going to last, but I do think these countries are in different positions, in different life cycles of tolerance of this virus and how much they're going to let it affect their lives. That's pretty much it for this video. Thanks for watching. I have got more videos coming out over this week. I shouldn't really be behind on my usual upload schedule, but I am hoping to get a couple more of these walking type videos. Unfortunately, there's a storm in the UK. It is 80-mile-an-hour winds right now, and this house is 30 meters from the beach, so if I step outside you won't hear a thing, even with my great big windsock on the microphone. As usual, thanks for all the support recently. If you want to help the channel, if you want to support me and join our community of investors and watch us grow and grow with us, then check out our Patreon. There'll be a link down below in the description. Thank you to all these patrons, because you make this absolutely possible. You give me consistency, and we're building a brilliant community. There are also affiliate links down below in the description for masterworks.io, a company that allows you to invest in fractional shares of fine art, and BLOCKFI, a crypto earn platform that gives you interest on whatever cryptocurrency you hold. Personally, I like to use it for stable coins. Once again, thanks for watching. Thanks for all the support. Stay stoic. Until next time.